Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And things have shifted quite a bit since we spoke last week. Last week, things were starting to improve a little bit on the market side of things. We had talked about the fact that markets were looking fairly unhealthy, but that the market breadth was weakening. The fact that we didn't have confirmation on many of the major indices were concerning. But at the beginning of last week, things were starting to improve a little. But as we have seen here over the past week, things have actually gotten significantly worse. So we want to dive into what has transpired, what has shifted, and kind of perhaps what the market is focusing on more rather than the inflation debate, which seemingly has been largely settled. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off as we normally do by taking a look at the major equity indices. Taking a look at also some of the, I would say, two stocks that represent the current market conditions that we're in. Then we'll take a look at the fixed income markets, a big shift here in the fixed income markets and how that affects everything from commodities to the individual sectors. Then we'll take a look at the sector rotation model to understand where sectors are moving, and then taking a look at some of the important economic indicators for today before sharing with you some of our ideas. But the primary question that I want to help investors answer from today's session is really, are the rising COVID cases a reason for equity markets to continue lower? So we'll take a look at kind of what's moving the markets and what I think is important to pay attention to. So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I want to share with you my charts, my economic research, my decision-making process for looking at the current market conditions. So two things that I want to point us to: Delta Airlines and Kroger's, two stocks that I think represent what the market is currently paying attention to right now. We saw a very sharp move here to the downside in Delta Airlines yesterday, and then a very sharp move here to the upside in Kroger. This really reminds us of the early days of the coronavirus. There wasn't any particular big news on the airline, certainly wasn't any big news on Kroger, yet we saw this huge move up in the supermarkets, a big move down here in airlines. That, again, reflects the panic, if you will, that we saw in the early days of the pandemic. So it seems like the markets almost overnight decided all of a sudden that this Delta variant of the coronavirus is very important to pay attention to. Despite this is something that's been in the news for a while, it's no surprise to anyone, but this is really when the market started to pay attention to. So let's take a look at the overall market and where it currently sits. The S&P 500 on the weekly chart remains in this very strong bullish trend. The daily chart very much remains still intact in this bullish trend, well within this particular channel. It is now testing near the bottom of this channel. Last week, we were talking about the fact that when we're near the top of the channel, that is not a good time to add long positions. But now that we've now tested to the bottom end of this channel, this could potentially be the opportunity to look for a long position here. But we do want to pay attention to see if it breaks this channel. If it breaks this channel, then we would certainly reverse our directional view here at the moment. So we're at a pretty pivotal moment here in terms of what direction the markets may head in terms of whether it holds this channel or it starts to break below this channel. When we look at the Qs, the shape of this market has been a very strong uptrend since it broke out from 343 or so. It's now come back to the 21-day moving average. I do think that there could be some further downside here in the Qs with the NASDAQ 100 down to that breakout level around 343 or so. So if you look at this, the S&P 500 still very much within trend. The NASDAQ 100 still very much in an uptrend, but potentially showing a little bit of weakness to pull back towards prior support level and finding that support before it can continue moving higher. However, when we look at the other markets, the Russell 2000 is now testing the bottom end of this range that it's established since pretty much the beginning of the year. And the question is whether it bounces off the bottom of this range or it breaks below the bottom of this range. Pre-market so far, it looks like it's holding this, but I would really wait to see till the end of this week to see if it closes above this level or if it starts to break down below this level later this week. If it starts to break down below these levels, especially when you see it alongside with RSP, the equal weight S&P 500, which is currently in a very similar pattern, trading sideways here over the past 2.5 months or so. If we see a breakdown here on the equal weight index, that certainly would be very concerning for me, and that would likely lead to both the S&P and the NASDAQ starting to pull back even further. And we see the same type of market here in the Dow Jones. Dow Jones failing to break out to new highs. This is something that we talked about here last week. So now it's starting to test the bottom end of this range. If we start to see the Dow break down below these support levels, that is likely going to lead the S&P and the NASDAQ lower here as well. So I would say we're at a pretty pivotal moment here in the major equity markets as to whether or not it can hold these major support levels. The channel support in the S&P, the support levels here on the on the Russell 2000, the RSP, the Dow Jones Industrial Index. If we can hold these levels, that is the bare minimum the equity markets need to maintain a sideways or a neutral view before it can retest those highs and potentially confirm a breakout and continue on those bullish trends. But we are also very close to potentially breaking below these support levels and seeing further downside. And this really comes down to taking a look at some of the other things that are happening here in the markets. And the big movement that I would say here beyond equities has really been in the bond market. We have seen a substantial rally here in the bond markets here over the past couple of weeks. But yesterday, it really reached a bit of a panic mode, if you will. We've had this huge gap up in TLT. Whether this is a bit of a panic buying from investors who are trying to move towards safety, if you will, like we did in the early days of the pandemic, where we had the big moves up like this. While we're not there quite in the same amount of panic, and I wouldn't expect the same amount of panic as we did in the beginning days of the pandemic, the current price action certainly, reflects a bit of panic here in terms of buying. Now, whether this is panic buying because of flight to safety or a bit of short covering, those are some of the things that I think are both potentially at play here. We've had a massive amount of short open interest here in some of the bond futures, and what we're seeing here is basically some of that short covering here right now. So the question is really how much further can bonds go? And this is really, when you look at the charts here, you start to see a little bit of exhaustion here as we push for higher highs in price, momentum no longer confirming those new highs. This is showing some signs of exhaustion here, and we're starting to see 10-year yields revisit back to the 118, 115 levels here before, right after it broke out above the 100 basis point level. It tested this level twice, 115, 118, before it finally broke all the way up to that 175 level here. So we're finally getting all the way back to a prior support level here in yields. And the question is whether yields are going to bounce here a little bit. And the question is really, why have yields fallen so much, right? One, we talked about the kind of potentially panic buying or short covering we've seen in bonds. That's depressed yields quite a bit here. But also, you have that, you have the potential debate here now on inflation. We'll take a look at some of the economic data here for that. There seems to be further evidence that some of the concerns around raw material pricing, some of the inventory shortages, supply chain shortages, some of that is starting to ease, and that's kind of helping the inflation debate in terms of settling it, that things are more transitory. So all of these, I would say, events in confluence with each other have led interest rates to decline substantially here, perhaps even overshooting a little bit here to the downside. So this is really something to pay attention to as we go forward, because interest rates obviously have an effect here on equity valuations. But, I think for a lot of investors, they're actually concerned to see that, bond yields falling, yet equities fall at the same time. We're kind of used to the inverse relationship. As bond yields fall, equities rise. So this is speaking to a little bit of panic, if you will, in the markets, that we have not seen the typical relationship continue to hold. When these types of relationships break, that is the potential of, some market volatility. So this is one that we're really paying attention to. And I think this week will be a very pivotal week in seeing whether this panic buying in bonds, eases a little or kind of continues, depending on how investors are viewing the new Delta variant of COVID-19. When we look at gold, gold continues to form a little bit of a base here above 168 here or so after gapping down substantially here. It's found a bit of a base. It did manage to fill this gap. We talked about this gap fill last week. It did manage to fill this gap and bounce a little lower here. Now the question is whether it can break out above it. If it can break out above that gap, I think gold is likely to head back up into this 179 level here, which was the high back here from early June. So those are some of the things that we want to pay attention to here. And then we look at copper, we look at futures on raw materials. Copper remains holding this 420 level here or so, which is a support level prior to the last rally. And so far, copper prices remain fairly elevated here. But crude has seen a substantial downdraft here after the OPEC meeting, but it has held the 100-day moving average. So despite being in a very strong uptrend, it still remains in this uptrend. It is at potential risk of falling below this 100-day moving average. If so, then we would likely test 62 and potentially even 58 here to the downside. But so far, crude, potentially being a little bit more sensitive right now to the reopening or potentially lockdown, if you will, trade that we're currently in. So when we take a look at sector rotation, this is really where I had talked about for about almost 5 weeks, the fact that this market lacked rotation. Well, we finally started to see some rotation here over the past couple of weeks. As you can see, we have real estate, consumer staples, utilities, industrials, materials, all moving towards the improving category and improving both on momentum and relative strength. And at the same time, you have the strongest sectors: technology, discretionary, healthcare a little bit, consumer, not so much healthcare. Healthcare really hasn't moved so much. It's really more communications, discretionary, technology, and energy that has started to move towards, that has lost both relative strength and momentum here. So this represents to me a fairly healthy amount of sector rotation. So this is potentially one supportive evidence of the equity markets, capitulating, if you will, a little bit, or resolving some of the negative divergence and the lack of rotation and the lack of health, if you will, in the market rally. And this is, starting to see some of that improvement here. Is this enough to justify the markets to continue moving higher? I don't quite believe just in this as itself alone is enough, but it's certainly something that is moving in the right direction. But right now, I think what the markets have really reacted to is really this sharp rise in COVID cases that we've seen here in the UK. And the reason that this is so, I think, important is because the UK represents a country that really had spent quite a bit of its efforts on vaccinations and has largely led the developed nations in terms of vaccination rates. Yet, despite that, the Delta variant has become, almost equal to what they saw prior to in the beginning of this year, at the end of last year, in terms of the Alpha variant. And this is the chart here for the US. Daily cases have started to pick up here. It's still pretty early days in terms of it's nowhere near what we saw here back here in the same time in December and January. But certainly this is something that we want to keep an eye out for, because, in the early days of, I would say a month ago in the UK, they were in a very similar spot, just very early days, looking back towards beginning of the year and maybe even the November of last year when things were relatively calming down here. And then you've had this extreme move here to the upside, despite being fairly vaccinated. Here in the US, the question is whether or not this is likely going to happen here as well. And I think this is what investors are panicking at the moment, because there is still, vaccination rates in this country have declined substantially. And the question is whether or not we're going to see something similar to this. The one, I would say, positive that we have seen out of the UK is the fact that vaccinations have been able to keep deaths at a fairly low rate. So that is a good thing. And the US is not too far behind the UK in terms of vaccination rates. So for that reason, there's going to be likely some kind of panic. There's likely going to be perhaps a little bit of an overshoot in terms of how investors positioned for safety, like we saw in the early days of the pandemic. So those are ways that we want to pay attention to right now, potentially as opportunities, because especially when you look at the inflation debate that we continue to have, there's a lot of things that seem to be easing a little bit in terms of the number of industries reporting wage growth greater than 3%. We've seen a significant decline here over the past couple of weeks. In terms of the past couple of weeks, we've also seen a fairly significant decline in terms of mentions of shortages across quite a few of the major sectors, across autos, furniture, electronics, and apparel. So this continued decline here in shortages alongside with wage concerns have started to ease. This is going to further, I would say, support the Fed's debate that inflation that we're seeing here is still fairly transitory. So, the economics certainly seem to agree with what the Fed's saying. I think that what we're now concerned about beyond inflation is actually whether or not the second half of growth is going to be as strong as perhaps the markets were expecting. If you look at the equity markets even a month ago, I think we were largely priced to perfection in terms of very strong first half growth and a fairly strong second half in terms of growth. And I think right now the markets are reconsidering, whether that second half is going to be as strong. We've seen quite a few major analysts such as Bank of America have reduced their second half GDP expectations, or full year 2021 GDP expectations are starting to come down a little. And I think we're starting to get back to a bit of more normal in terms of being able to predict fairly accurately what GDP is going to look like. And I think that markets are kind of repricing a little bit in terms of what the second half is going to look like. I don't necessarily think that we're going to see this huge shift, but certainly I think the equity markets are trading a little bit back to reality. I think a lot of investors may have felt that equity markets have lost all, coupling with reality and kind of where the fundamental numbers are. This is kind of the markets rethinking a little bit of rethinking as far as where equity valuations are and where they should be. So as we look for opportunities here in this market right now, my preference is to still be a little bit more defensive, because I don't think the rise in COVID cases is done here. And I think as it continues to rise, investors will be a little bit more freaked out, if you will, as we saw that kind of lockdown trade happen yesterday between Kroger and Delta. I could see that happening. I could see that going on for a little bit more time, a little bit more extended before things kind of get better. So for those reasons, my preference is to be more defensive, and you can find defensive in defense here. So a name like Lockheed Martin that has found a little bit of weakness here, finding a little bit of support here around this 370 level here or so, looking for a bit of a bounce here. Looking for safety within defense is certainly one place that I would look, especially within infrastructure spend. Another one is looking at some of the stocks that really have oversold substantially here, like Las Vegas Sands here over the past couple of weeks, reaching some major support levels here around $44, $46 or so, finding almost a little bit of capitulation here to the downside and playing for a little bit of a bounce. This is a little bit more on the speculative side in terms of trading, but if you look at domestic leisure, if you look at Las Vegas, numbers look very strong here in terms of the number of people traveling to Vegas, the number of rooms that are being occupied, the average price per room, the average spend per room, those numbers look fairly strong. And this is an example where I think the charts have taken a bit of an overstep in terms of concerns around the Delta variant, concerns around some of the travel. And I think some of the airlines reflect a similar trade. But again, some investors are concerned about catching a falling knife, and I certainly understand that. But these are the types of opportunities where you could see a sharp bounce. Think about the early days of the pandemic when things oversold, and you had a very sharp bounce. Is this the same conditions? Hard to say in terms of timing, but it certainly is the same in terms of the type of trade. And lastly, when you look at some of the names that have just continued to struggle throughout the recovery, have seen a little bit of strength here over the past couple of days because of this concern that we're going to go back into lockdown. I don't necessarily know that we're going to go back into lockdown. I think those concerns are overblown. So those are the types of opportunities that I would look for more of a fade. Stocks that have rallied a little bit, even Kroger here over the past couple of days, I think, that strength is a little overblown. I don't think people are just going to go back to the supermarkets and start stocking up like we did in the early days of the pandemic. So when you have some of these stocks that are that have gained from the lockdowns, but have started to see a little bit more strength here over the past few days. Those are stocks that may likely fade over the next few days, especially over the next few weeks if the Delta variant starts to ease a little bit and we start to see a bit of a slowdown. We're already starting to see a bit of a slowdown in terms of, this pace at which the UK is growing in terms of cases. So as long as we can see a containment and as long as we don't see deaths spiral out of control, this is really something that I think we could continue to fade these types of strength. So that's the way that I'm thinking about the markets here right now. Like I said, a fairly substantial shift here from last week in terms of focus on inflation, now focus on second half of growth, and whether or not we're going to see that same amount of growth because of the Delta variant. This is going to be an evolving I would say, thing that we're all going to have to pay attention to here for the next few weeks. But this is really where you want to focus your attention more so on, rather than that inflation debate, which I think, based on the evidence, based on the economic data so far, looks fairly, I would say, settled in terms of that inflation right now is unlikely to run away for the second half of this year. So with that, thank you so much. I hope that this helps give you a better understanding as to how investors are currently viewing this market and what you should pay attention to make your trading decisions. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.